Welcome to EPG Pathshala. I am Dr. Preeti Shirodkar, Associate Professor Communication and Soft Skills, MET Institute of Management. And today, I would be talking about remittance by the diaspora and its impact. Let us think about some interesting facts regarding remittance by the diaspora on an individual level and on the level of the country. On the individual level, there are 2 points that one needs to think of. One, that the diaspora's remittance has no doubt a benefit in the kind of facilities it offers. But on the other hand, it also creates an endless chain of migration despite the difficult circumstances abroad, because there is a dependency by the family back home on the remittance. Also, because of the remittance, there is a discrepancy which is created between those who have remitters who can send that money from abroad and the families who don't have such remitters. At the national level, there is a different kind of a problem. One is the black money that remittances and hawala creates, and the second is the financial dependency that is created by excessive dependence on remittance during the time of crisis. Let us now set the context. There is no denying that the diaspora plays a very important role in the development of the homeland. It contributes in many ways, among which are remittances, foreign direct investments or FDI, entrepreneurship, philanthropy, etc. Accurate data on migration for the majority of the countries is difficult to get, and India is no exception. According to the Ministry of Overseas Indian Affairs, the MOIA, India has the second largest diaspora in the world after China, with around 25 million people living in some 110 countries in all 6 continents. Migration in India has 3 phases. 1. Early migration of unskilled labor to work on plantations and mines in British colonies as indentured labor. 2. 20th century migration of high-skilled professionals to advanced industrialized countries of the West. And 3. The late 20th century migration of unskilled and semi-skilled workers to Gulf countries. Remittance in India is a two-way phenomenon. It is a receiver of remittance from abroad as well as a source of remittance for a few countries like Bangladesh, Sri Lanka, Nepal, etc., sections of whose population work here. Interstate migration within India forms a large chunk of the remittance. Among the people to whom India remits, countries like Bangladesh emerge at the top, followed by Nepal. Let us now look at the definition and characteristics of remittance. Remittance refers to unrequited transfers, referring primarily to money sent by migrants to family and friends on which there are no claims by the sender. In certain developing countries, remittances account for more than 20% of the gross domestic product or the GDP. Remittances, furthermore, increase the recipient country's foreign exchange reserves and are less volatile than other sources of foreign exchange earnings. They thus support the financial sector development through a strong and positive impact on bank deposits and credit to the private sector. This does not mean that there are no difficulties. Let us now look at the difficulties of estimating remittance. Even when remittance data is available, countries often classify it incorrectly. Many countries report workers' remittance as other transfers. Moreover, only a few countries report bilateral flow of remittances. In fact, remittances cannot have exact numbers because remittance gets remitted through varied channels. These include banking, postal services, private players, and hawala. Of all these, only those which have a proper receipt system can be counted. Let us now consider some worldwide remittance patterns. Millions of migrants send remittances to the family and communities that they belong, is a fact that we've already discussed. In 2009, worldwide, remittances were estimated to have totaled to 414 billion US dollars. Interestingly, Chinese diaspora is larger than India, but they receive comparatively less remittance. According to AFRAM, in 2009, the top remittance receiving countries were India, 49 billion, China, 48 billion, Mexico, 22 billion, Philippines, 20 billion, France, 15 billion, Bangladesh, 11 billion, Spain, 10 billion, Germany, 10 billion, and Nigeria, 10 billion. These remittances have helped in enabling better healthcare, housing, marriage, community works, and education, both in the families and in the nation. The spending patterns of the remittances, however, depends on varied factors such as the strength of the migrants' kinship ties and intent to return to the country of origin. Migrants who intend to return tend to remit more than those who are permanently integrated into the host countries. What one needs to remember, though, is that remittances are an important source of external financing for developing countries. In fact, international migration is perhaps the second largest source of net financial flows to developing countries. Let us now look at the Indian scenario. Migrant remittances to India have recently come up onto development agendas worldwide. They form a very important component of the nation's balance of payments, especially in developing countries like India. The major remittances reasons are money sent by parents to children and children to parents, as also the money spent for special occasions. Moreover, whenever migrants return home, they bring a lot of gifts for family members. In the Indian context, the maximum remittance that India receives is from the US, followed by Saudi Arabia and the United Arab Emirates or the UAE. This is because the Gulf countries rarely allow permanent migration, and so the remittance from these countries is very high. Moreover, the proportion of households sending and receiving remittances is relatively high in rural areas as compared to the urban areas. While about 5.2% of rural households claim to send and receive remittance, only 3.1% urban households sent or received them. On an average, about 20% of the funds received by way of remittance are deposited in bank accounts, and about 7% of the funds are invested in land, property, or securities. Let us now think about the role and function of remittance. Remittance helps to improve economic growth, especially if used for financing children's education and health expenses. Even when they are used for consumption, remittances generate multiple effects, especially in countries with high unemployment. In India, a large part of remittances are invested in gold, real estate, housing to families back home. Remittances generate positive effects on the economy by stimulating demands for varied goods and services. In the context of India, the transfers increased steadily during the 1970s, remained more or less flat in the 80s, and started picking up sharply during the 90s. Since the beginning of the liberalization era, these transfers have become an important component of India's overall balance of payments. Inward money transfer for family maintenance was primarily earlier dominated by hawala, but now other modes of transfer have emerged, and 40 to 50% of the money is transferred through proper channels. Host countries allow resident Indians to credit money to their home-based accounts directly, and they can make someone back home withdraw the money from their account. Remittance is an important factor as regards family obligation and currency of care. Let us see how. In many developing countries, remittances play a very crucial role as insurance. They also serve as financial consumption, land and housing purchases, and for philanthropy. They are an important source of social insurance as well. They provide liquidity for small enterprises as well as capital investments, equipment, land, wells and irrigation works, and education with long-term implications for economic development. Remittances provide social protection to poor households. India has moved in various ways formally to harness and acknowledge the expertise, wealth, and contacts of the diaspora. The report by the Singhvi Commission on the Indian Diaspora observed that many wealthy PIOs, individually and collectively, support projects addressing basic needs such as health, education, and infrastructure in their home states and villages in India. Furthermore, during times of acute crisis, community and religious organizations have mobilized significant funds and expertise to help in relief efforts. The major areas of contribution thus are social causes, disaster and conflict management, building religious sites, and providing scholarship. Rarely, they are used to establish new businesses and industries. On a personal front, once these remittances are sent, they improve the recipient's living standards. Post that, they are invested in consumer goods, housing and land, as well as in bank deposits. This is, however, not to deny that remittances have negative aspects too. For one, they have pushed up the prices of land and construction materials, consumer goods and food articles, rent and charges on health, education, transports, etc. back home. Furthermore, to be able to send remittances, immigrants have to suffer a series of abuses and poor living conditions, which lead migrants to committing suicide, especially in the Gulf countries. Finally, women may need to fill in for absent husbands in many ways, including the care of animals and working on the family farm or in the family business. In some instances, the sporadic nature of remittances may also force women to generate cash income through wage work. Let us now consider the channels and procedures of remitting. Handling billions of dollars in remittance is a lucrative business today. Major nationalized banks in India and in the Indian Postal Services, as well as private financial enterprises like Western Union Money Transfer, are playing an important role in the field of exchange. These agencies charge from 6 to 14% of the remittance amount as fee, while the traditional Hawala system, common in South Asia and the Middle East, is much cheaper at 2.5% and is believed to account for nearly 40% of all remittances to India. Furthermore, with the increasing use of technology among financial service providers, internet-based provision of remittances is a fast-growing business. It is evident from this that the true cost of sending remittances is small. However, exorbitant fees up to 30% on an average and frequently as high as 20% are charged by money transferred agents. These serve to drain out the hard-earned remittances of the migrants. These fees especially affect poor migrants who remit only small amounts and they are forced to pay proportionally more. Large remittance service providers have persuaded the postal network banks with extensive branches to sign exclusive contracts that limit the access to competitors to the well-developed distribution network. All these are causing problems for the remitters. What can be the suggestions for improvement? The cost of remittance can be lowered by applying varied methods and techniques to policy changes. If all remittance receivers have access to bank accounts and Indian banks open their branches in host countries, this would definitely lower the cost of remitting. Moreover, the government needs to regularize the cost of remitting money and also needs to bring transparency into it. Technology can further help to reduce the cost to some extent. Many countries are using technology, in fact, in providing remittance and other financial services. The GCash product in Philippines and the M-Pesa in Kenya are successful examples of providing remittance and other financial services through mobile phones. The presence of large telecom service providers in India can surely help in reducing the remitting cost. This will surely be beneficial, but will also help the government. For this, the government needs to introduce certain financial plans through banks, which can help them to get a loan or better interest on deposits. Let us now look at remittance, investment, FDI, and philanthropy. The FDI in India has gone up significantly in the post-reform period. In 2010-11, it was estimated at around 1,78,110 crores, which is far behind the remittance sent by Indians back home. Unlike FDI, the remittance goes directly to the family, so it has a direct impact on poverty alleviation of the household. Given that investment of remittance completely depends on the receiver, most of the money is spent on household expenses. India also tries to tap investment from its diaspora in varied ways. These include issuing bonds to them through RBI in association with SBI, the India Development Bonds, Resurgent India Bonds, and the India Millennium Deposits. Most of these funds have been raised by the Indian diaspora to counter the foreign exchange crisis in the country. Overall, one needs to understand that remittances are required. One cannot make do without them. In fact, remittances have brought a lot of positive change in the life of people back home. However, one really cannot deny their negative impact. It is therefore required that there is a better support system from the government which can bring several changes to the life and working conditions of the Indian migrants abroad. Because without that, just getting remittances from there is not good enough. A better recruitment policy and support from local embassy can bring about fruitful changes. This will ensure that over and above bringing in remittances to the country, there will also be a greater joy for these diasporics to work abroad and better living conditions for them as well. This will ensure a greater quality of life for Indians. All this is really important while looking at remittances, because remittances is not about money. It is about the quality of social, cultural, and economic life. To conclude, what one needs to understand is that there is no doubt an impact on the GDP and the FDI and the overall financial sector through remittances. However, the government needs to be cautious because excessive dependence on remittance can have a very negative impact in the long run. What is very, very important is that the positives of the remittances have to be made better and encashed on more strongly, and its drawbacks have to be reduced so that the remittances can serve both for personal and national growth in the long run. Thank you.